Okay guys, welcome back to Forex class. This is Forex class basic 2 lesson 3. I want to advise that you keep on coming to watch the videos so that you are not going to lag behind others, because many other people are already flowing with the class. Do you understand? So today we are going to be doing Forex class basic 2 lesson 3. It's going to be the second to the last video on basic 2, after which we are going to enter into the advanced classes. You wouldn't want to miss out on this trend because we've said so much. And like I said, if there is anything you don't understand, you should try to put your question in the comment section, and I will attend to them in subsequent videos. And also, we're going to be doing a review of all we've done so far in our in-house review class on Sunday. So because of that, many questions will be answered, a lot of things will be said. So for those of us who are on YouTube here, we may not be beneficiaries of that review class. So what I will do is I'm going to record the class, and then I'm going to upload it here also for you guys to see. Do you understand? So that you can also watch and see people's review, their comments, their questions, and how I will answer them before we go into the advanced classes. All right, just a quick one. Trading leverage products as forex, derivatives, commodities, metals, binary, and crypto may not be suitable for all investors, as they carry a high degree of risk to your capital. The materials and slides shared in this video are simply for education purposes. Go Capital will not be responsible for any loss incurred as a result of the information shared. This video is my personal opinion, and you agree that whatever actions you take based on them is strictly at your own risk. This is not a financial advice, simply for education purposes. All right, let's go to the class. What is balance? In trading the foreign exchange market, there is the ability to trade the market with money that is not your own. It is known as a demo trading. That is a virtual account where the forex broker whom you registered with will give you funds for you to trade the market, for you to access the market, and also assess it, to assess and to assess. What that means is for you to get access to it and then be able to run an overview and to assess it, to measure how your performance would be when you start trading a real account. So when you start trading a real account, you are not going to still be trading with the former demo account that you were given with free money. No, you will need to deposit money into that forex account. So you can't start forex trading for free. You will need money to start trading forex. So that money you will deposit into your forex account is going to be whatever you want it to be. Let's say $1,000, $2,000, however your financial capacity is and whatever your risk appetite is. So if you deposit money into your forex account, it is going to appear in the balance. So the balance is the total of your account when you have not opened any position. So if you remove all positions that are opened, the money remaining in your balance, the money remaining in your account is your balance. Looking at this screenshot, this person had $22.58 in the forex account before he opened all these positions you are seeing here. So the balance is a total of your account excluding open positions. The balance only includes total closed positions. If a position is open, it won't reflect in the balance until it is closed. Just like you see here, this is a balance of the person, which is $22.58. These are open positions at the bottom here, one of which is AUD/JPY, and the person is in profit of $6.36. This particular trade that you see here is in profit. That's why it is showing in blue, this part. If it was in loss, it would be showing as red, but it's in blue, so it's in profit. So this is in profit of $6.36. If you add this to 22, you will say that it's supposed to be more than that, but the balance is still showing as 22.58. So what I'm trying to say is the balance will always remain intact, will always remain static, without fluctuating until you close any position. So if the open position is closed in profit, then it will be added to your balance. But if it is closed in loss, it will be deducted from your balance. Balance does not fluctuate. It will only change when a position is closed. It is the amount in your account before you opened any position. So right now we can see that the balance is 22.58. So the balance is your money that you deposited before you started trading. It will only fluctuate after closing a position. If you close a position in loss, it will be deducted from the balance. So next slide, what is equity? Equity is the next topic here, next subtopic here. In forex trading, equity is the total account balance plus or minus total open positions. Equity includes balance plus profit or minus losses. Now look, this is the equity in this place. This is the formula for it. Equity is equal to balance plus profit or losses. So remember that if it's a loss, it will be negative, so it will be plus minus what it is, and plus minus is minus. So equity for this account that we have here is the balance is 22.58 plus this is the profit. All of these ones here, if you total them together, you will have $85.76 US. So this is where the profit will show. It's at the top. This is a screenshot of a phone. So if you have all these trades added together, you plus this and this, plus to this and to this, you will have 85.76 as your profit. So this is the total profit at the top here. This profit, when added to the balance, becomes your equity. So now let me let you know that the equity keeps on fluctuating throughout until you close all your positions. Equity stops fluctuating where equity equals to balance when you close all positions. I didn't say this on the slide, but take note of this. Take note of this. Equity equals to balance when you close all the positions. So let's come back to this point here. If you have $1,000 as balance and you have a position open with a profit of $100, then your equity will be reflecting as 1,100. That's what you are seeing here. This is the balance. This is the balance before we open the position. So, and all of these ones were the positions that were opened. There were 4 positions opened. All 4 positions total together will give you $85.76. And if you add that profit, in this case $85.76 to the balance, which is 22.58, you will have 108.34, which is what is here in the equity. I hope you understand. So your equity is a total of your capital and your profit, or your balance and your losses. The capital is the balance. Do you understand? So the total, if you add the balance and the losses together, so had it been all of this were negative, you will subtract from the equity, and that you will subtract from the balance, and that will also be your equity. Then what is margin? Margin is the amount required for you to enter a position depending on your leverage. Margin is the amount required for you to enter a position depending on your leverage. I will explain with this table. Say your account has a leverage of 1:100. It means 1% of your account will be required for you to enter a trade. If you have a leverage on your account and that leverage is 1:1, it means 1% of your account is what you will use to enter any particular trade that you want to enter. So if your leverage is 1:1000, then you are using 0.1% of your account. Do you understand? 0.1% of your account will be the margin required for you to enter a position. You must always remember the leverage with which you opened your account with your broker before entering any position on your account. So let me use this table to illustrate. For a case of a leverage of 1:1 and you want to enter one lot size. This is one lot size. One lot size is one standard lot size, which is 100,000 units. For you to be able to trade 100,000 units with an account of 1:1, then you will need to have $100,000 also present in your margin for you to be able to enter the position. In this case, the broker is not assisting you with anything, so you are using 100% of your account to trade. Then for an account of 2:1, you'll be using only 50% of your account to buy the same volume, which is one standard lot size, which is equivalent to 100,000 units of that currency. So with the margin that will be required of you to be able to buy something that is worth this amount will be $50,000. Then if you are given a leverage of 50:1, that is, you'll be using 2% of your account, of your balance. That 2% is now 2,000, because the required margin for you to buy one standard lot size with this is that you will use 2% of your account. So 2% of the 100,000 that you want to buy is going to be $2,000. Now for an account of 1:100 or 100:1, it means you'll be using 1% of your account as the required margin, and 1% of one standard lot size, which is 100,000 unit, is $1,000. Are you getting it? So 1% of this is going to be 100,000. Are you with me now? So then if you have a leverage of 200:1, it means you'll be using 0.5% of your account. So for a standard lot size, which is 100,000 units, you'll be using just 0.5% of this to buy something that is as large as this. And what you will need is $500 in your account. So for a broker that offers you the privilege to trade with a leverage of 200:1, and if you want to buy a standard lot size, what you would need in your required margin is $500. Remember that this required margin is the money that your broker will lock away. You can't lose this one. You cannot lose the required margin. If you lose all the money in your account, the required margin will be intact. Your broker will close the trade. By the time you lose all the money in your account and it's remaining only the $500, then your broker will close. That's at the time you will receive a margin call. I will talk about that as we progress in this study. Then for an account that you are given a leverage of 400:1, that would mean you will need 0.25% of your account to buy anything you want to buy. So, and if you are buying a standard lot size, which is 100,000 units, you'll be needing $250 to be able to buy this size, this volume, this amount. So if you are offered an account of 1,000:1, then you'll be using 0.1 of your account to buy. So 0.1 of your account is going to be, of this particular volume, is $100. So that's what it is. So for you to buy a 100,000 units worth of a currency, which is a standard lot size, a standard volume, you will need just $100 if your broker is offering you a leverage of 1,000:1. All right. Then what is free margin? If you look at this table, this screenshot here, we've looked at balance, we've looked at equity, we've looked at margin. I'm still going to touch on this margin later on when I'm doing the summary. Now, what is free margin? Free margin is the money in your trading account that is still available for trading. Free margin is a margin of your open positions subtracted from your equity. So this is the formula. Free margin is because of equity minus margin. So in this screenshot, the equity is 108.34, which is this, minus 20.88, which is 20.88 is your margin. What you will get is a free margin, which is this. So when you subtract margin from equity, you will get free margin. So remember that this margin is the money that have been taken by the broker. This is the money your broker took from you for you to be able to open all these 4 positions. So this money cannot be lost. This one will be returned to you when you closed all the trades. So out of the $22 that this person, $22.58 that this person have in his balance, he has used 20.88 of it to enter these 4 positions. Do you understand? So the person is actually in profit, and that's the reason why you can see that the equity is 108.34, because profit plus your balance will give you the equity. So this particular equity will keep fluctuating as all of these are fluctuating as well. Do you understand? They will keep adding up automatically. You don't have to do this manually. I'm just teaching you so that you understand how you can use proper lot size on your account for proper risk management, because that's the reason why I'm teaching you about balance, equity, margin, free margin, and margin level. So you will need to know that all of these are done automatically. You don't have to sit down on your desk and be calculating them, though as a beginner you have to, so that you will know what to do when you want to enter a trade. But a point will come where only with your eyes you'll be seeing everything and you don't need to do all of that. So but you will have to get there by constant practice and by constant visiting of the video. So now let's look at the free margin again. The free margin is the equity when you subtract the margin from the equity. So that tells us how much you still have that you can use to trade. Now you can, since you've made a profit and all of these are part of your money right now, if you add this plus this, you will get this. So the broker have taken this from you. You can no longer use this to trade. So when you enter another position again, your broker will take from this free margin and add to the margin for you to be able to open another position. So this is the money. The free margin is the money still available for you to be able to enter other positions. So this money is free. You can still use it to trade more if you so want to trade more. Okay. All right. So margin level. What is margin level? Margin level is the ratio of equity in the account to used margin expressed as percentage. Let's just look at the calculation so that you will understand it and forget the grammar. The margin level is this equity all over your margin multiplied by 100 over 1. So you are trying to know the money that the broker took from you to be able to enter all these positions. What is the percentage? How many of it are in your current balance and profit? Like your balance and profit together is the equity. Now, what the broker took from you for you to be able to enter the trade, how many of such can you get inside of the equity? Now, you have to express that in percentages. So it means you still have, if you look at this calculation here now, which is 108 over 3.4 times 20.88 times 100 over 1. The percentage is 518%. It means you still have times 5 of your margin. It means you have times 5. So your margin level is reading that what your broker took from you is just 1 over 5 of everything that you now have. So the margin level tells you your current equity regarding the margin compared with the margin. So compared with the margin, this particular trader here, this particular screenshot you are seeing here is showing to us that this person have times 5 of what the broker has taken from him to be able to enter the trade. That's what the margin level is trying to tell you. So whenever, now let me do this for you. As a trader, you must not allow your margin level to reduce to 1%. If it does, you will receive what is known as a margin call. All your positions will be closed. Your broker will give you what they call a margin call, either to your email or to your phone number, depending on how you set your notification from the broker, from the MT4 terminal. So some of your positions will be closed automatically if your margin level reduces to 1%, because it means that you've lost everything remaining just what your broker took from you to enter the position, and you can't lose that one. So it will have to close all the trade for you. So if your broker does not close some or all of the trades, you must be losing into their money, and they won't allow that to happen. So the margin is the money they took from you for you to enter the position. You can't lose that one. If you lose all the money remaining in your free margin and is remaining just 20.88 in this free margin, your broker will automatically close all the positions for you. So this is what the margin level helps you to know. Don't ever allow your margin level to reduce to 1%. If your margin level reduces to 100%, it means you have just the same amount that your broker took from you remaining. It means you have just the same amount left. If you want to, what I'm trying to tell you now is, had it been that your margin level here, your equity is showing 20.88, that's what it is showing. Everything here will be 1. Then when you multiply by 100, what you will have is 100. So by the time your equity gets to 100%, it means you have not much again. You only have times 2. You have just your margin and then the same amount of margin as your free margin. When you start losing and reducing and it gets to 1%, your broker will close the trade on a margin call. What I'm trying to pass across to you now is what you must know, so that you will not over leverage your account. You must understand what leverage is for you to know what your broker will be taking from you per trade. And all of these figures, they tell you what is happening on the account as it is. So looking at this screenshot I've been looking at since, the person has $22.58 in his trading account, and the equity, which is after it has made profit, the trades are still on, the positions are still open. The equity is 108.34. Now the person's margin, which is what the broker took from him to enter all these 4 positions, is 20.88, which is the margin. What is now remaining from this equity is 87.46. Do you understand? So if you calculate this as it relates to the equity, it will tell you your margin level. What I'm trying to tell you is, don't let your margin level get to 1%. In fact, don't even let it get to 100%. Let it be above 100% every time you enter a trade. Whenever you see that your margin level is getting less than 100%, it's advised that you close all the positions you have, so that you will still have profit remaining in your account. Okay, so we'll move to the next slide. Summary. This is where we summarize everything that I have been talking about. Free margin is the money in your trading account that is still available for trading. I've talked about this before. So free margin is the margin of your open position subtracted from your equity. So now let me do a summary of all of this for you. This is balance, right? The balance on this screenshot here is 22.58. the equity is going to be balance plus profit or loss. This is the formula I gave you before, which is the balance is 22.5, which is this, plus the profit, which is what we were saying up here. This is the total of all of this profit that are here. So that will give you 108.34, which is what you see here on the equity. Then margin. Now I told you I will explain the margin, so this is the explanation for the margin. If you look at this trade that this person have opened up, these are 0.05 lot sizes, and this is actually a micro lot size, and this is 0.5, so which is 5 micro lot sizes. 5 micro lot sizes, that's what the person took on each trade. So if it was 0.01, remember that the number to denote a micro lot size is 0.01. The number to denote a mini lot size is 0.1. The number to denote a standard lot size is 1. So 0.01 is micro lot size, and the person is taking 5 of 0.01. So that's why you're saying 0.05. So this person is taking 5 micro lot sizes per trade. Now 5 micro lot sizes for each, and we know that a micro lot size is 1,000 units. So for the 5, it will be 5,000 units each. And the person opened 4 positions, which is 1 for AUD JPY, 2 for Euro GBP, and the last one for USD JPY. So he opened 4 positions. That would mean the person is buying a total of 20 units, 20,000 units in total, because each of these now is 5,000 units each, since it's using 0.05. So that's the volume the person is buying. So the person is buying a volume of 20,000 units each together, rather in total. So since margin is showing 20.88, it means that account has a leverage of 1:1000. So this is the total unit the person is buying, 20,000 units. Now since the account is showing that the margin, which is what the broker took from him, is 20.88, it means that account has 1:1000. How? Divide this, multiply this 1000 by this 20.88. You have 20,888. Actually, this 80 that you are seeing here is just probably the commission. It's supposed to be maybe 20.00. Do you understand? But maybe the commissions that the broker took from the trader when he was entering the position, the total of them is 0.88. That's why you are seeing this 20.88. Actually, it's supposed to be 20.00. So with the knowledge we have before, this person is using a leverage of 1:1000, because if you are using a leverage of 1:1000, I told you that you will only need 0.1% of your account to be able to trade that thing. So 0.1% of the unit. So since the person is buying a trade of that is worth 20,000 units in total, what would be 0.1%? Let's go back to the previous slide. So if you look at it, I told you that 1:1000 means you are using 0.1% to buy this. So 0.1% of this is this. Since the person is buying an account that is total 20,000 units, 0.1% of this is going to be 20.00. You understand? So this 88 you are seeing here is just maybe because of the commission that the broker took from the person while entering the trade. Do you understand me? So for a 1:1000, you would need just 20.00 to buy 20,000 units. That's why this margin is 20.88. Do you understand? So then for the free margin, I have already told you that the free margin is your equity minus your margin, and that is 87.46. This is what we got here. And then also your margin level is with this formula, equity over margin times 100/1. That will give you 518.88, which is what you see in this place. So what you must understand here is the margin. If you are buying just 10,000 units in total and your broker has given you a leverage of 1:1000, it means you will need only $10 to be able to buy 10,000 units of it. Do you understand? So that is what you should know about forex trading. With this that you have learned, you are way ahead of a gambler. Someone who does not have this knowledge will just enter any loss site he or she likes. That's not how to trade. You calculate the account. Now there is a way to do all of this automatically in case you are not that good in mathematics. You can use a website that we call myfsbook.com. So if you use myfsbook, you'll be able to calculate all of these things at once. You'll be able to put your balance, the loss size you want to take, and your the calculator will just calculate for you everything that is required for you to trade that position you want to take. So, and I would actually advise that you should risk more than 1% of your account whenever you are entering a trade. So I will talk about all of that when we enter the advanced class. So, but this calculation is important for you to understand what we'll be doing in the advanced classes, because in the advanced classes we'll be doing live trades, we'll be talking about things. So you'll be seeing the reasons why I'm doing most of the things I do on the live account. Do you understand? Because I'll show you live accounts as time progresses. All right, with this we've come to the end of the class. I will plead with you, please like this video, subscribe, share, subscribe and share with your friends. Please and please, this is the only way you can make this channel happy, make me happy, and make me motivated to do more videos for you. All right, with this we've come to the end of the class. Thanks for watching.